Welcome to video lesson 4.2. In this lesson we will be discussing the highs and the lows. Pre-topics will be highs and the lows. We will be discussing the high and the low of the day, the week, also the month. We will also be discussing the high or the low of previous structures, like the high or the low of yesterday. We will be talking about daily range as well. How the dealer can only move a certain amount before he has to reverse. The dealer cannot move hundreds or thousands of pips in one day. He as well has his limits. We will discuss liquidity and how liquidity is trapped at these highs and the lows of each day, each month, each week. We will discuss stop loss and take profit zones of retail traders and where retail traders are determining where their stop loss and take profit will be. Traps, we will be discussing trap zones and where the dealer works the highs and the lows to trap a certain amount of liquidity in these areas before making his initial move. We will also be discussing the completion of structure and trends by the creation of highs and lows. So, talking about highs and lows, we're going to start with a 15-minute chart here. We're on the Euro US dollar, and this was this entire week, 5 days. The market closed about 4 hours ago, and Euro USD, you can see this beautiful weekly structure here, only a bit inverse, but the same structure that we talk about a lot. We've discussed that a lot. So, here is the beginning of the week. Here is last week, which would be, if you could call this yesterday, the high of, let's just say yesterday, because I don't know what to call it, the high of the previous day. The previous day's high trapped liquidity in this zone, created that high right here. So, we can see the high was created, and then the dealer opened the market in that zone above that high and worked the high, spiked the high. But if we look at a higher time frame, we know that the high was not broken. We can see there were no candles that broke above this high, except for this star formation, which is a confirmation that we use. So that is a valid sell opportunity at this stop hunt right here. How did we know this was a stop hunt? Well, first of all, we know for a fact that 90% of the time the market will consolidate for 5 hours before closing and then open with 5 hours of consolidation. And this varies. For each pair it's more, some pairs it's less, some pairs it's more volatile. It's different for each pair. But this has to happen. This consolidation has to happen in order to trap liquidity in one zone to be able to move the market to another zone. So we can see the high was worked, and then after the 10 hours of consolidation, about 10 hours of consolidation happened, and then you can see that spike to the high to take out any sellers that had their stop losses above the high and induce breakout traders to buy that breakout of this new weekly high, thinking that they were going to take it long here. But what happened? The stop losses were hit and price moved down to the next zone and consolidated. So, the midweek, we've talked about midweek reversals and how in the middle of the week, the dealer tends to reverse the market, just like in the middle of the session, or I should say the middle of the day, the dealer, upon changing session, will reverse the market. This happens on a micro and a macro scale. And this is all to complete this whipsaw pattern. Oh, that's a really bad one. But yeah, that's basically the weekly pattern right here. You can see the consolidation spike to the high, drop down, come back up, and then end in consolidation here. It's just a variation of that weekly pattern. What happens midweek? Alright, we can see the consolidation in this area. After about 8 to 9 hours of consolidation, what happens? We see the dealer spiking to the high. He's working the high. So, there's a certain amount of trapped liquidity here because this is the new high of this new day, right? So, each new day, the dealer creates has a new amount of pips to work with. The dealer traps the amount of liquidity that he needs in this area and then works the high of the day, then comes off of the high and creates that low, comes off of the low and consolidates again. You can see that. But what we can also see is this would be Wednesday coming into Thursday. Wednesday, we have the low created here after that consolidation period. So the dealer consolidated in a very tight range and then spiked the low London session. You can see 8 hours later, that would be London session. Created that W formation at the low of the day, that reversal pattern, and then came up to consolidate in the next zone. So the weekly low, the low of the week, was not broken for the whole rest of the week. The dealer oh, I'm sorry, I got a frog in my throat. Okay, the dealer worked the low of the week here and trapped. You can see the little pin bars here. You can see the dealer was working the low, working past this trend line or support and resistance that the retail traders see or have graphed. That now becomes the low. There are trapped buyers here, or I should say trapped sellers here, believing that the market is going to keep going down. The midweek reversal is in effect, and the dealer completely reverses the market against the retail traders' trend. So, the next day, what happens? The dealer consolidates in a small range here, moves on to his next zone, right? And then stays in this zone, consolidates, spikes to the high, right? In one candle, we can see that spike to the high. We sell upon seeing that spike to the high and this star formation right here. We can see that little star and say, all right, that's a valid sell opportunity. Or we could wait a few more candles and see the dealer working this high. Liquidity is trapped in that range. If we didn't enter up on here upon seeing this, we could have entered upon seeing that M formation and then went against the trend for a nice 35 pips or so. Then we know the market created the low here. We know we were going against the trend here. This was just a correction in the trend. So where are we trading? We're trading up. We're buying. So we see this low, but what we can see is this somewhat of a star formation right here. This is the real low, and this was just the peak that came out to grab the orders. We can see the dealer worked off of that real low and then came up. There's that W formation right there. Now that was a tricky one, but nonetheless, the dealer still worked the low of the previous day and did not break the low because he wanted to keep traders trapped in this area. He had trapped liquidity in here and then dragged the price against them. Then the dealer finishes the day off in consolidation. Whoops. We can see the same consolidation zone that they opened the market in is basically the same zone in which they closed in. They closed and opened in basically the same area. Now let's talk about the daily range. How the dealer works the highs and the lows of each day and the range that he has in this market and on different pairs, because each pair has a different range, and we're going to use a calculator, a volatility calculator, to calculate the volatility or the range of each pair for each day. So the Euro USD, this is on investing.com. If you type in Forex volatility calculator, you'll be able to find it really easily. And these are averages, you guys. Just remember that. Remember, these are averages, and the market, the dealer can work the market really as much as he wants, but it's not going to be very far outside of this average. Otherwise, the average wouldn't be as small as it is. So, over the past 10 months, Euro US dollar has had a 74 pip range. Now, I have created a small box that is, well, this is 74 pips. So, my box is now 74 pips. The ADR box, average daily range. We are going to use this box to see each day and how the dealer fills his range each day. Some days the range will not be filled, and some days the range will be exceeded, like here. Upon seeing this, we can see the low. We put the box in the low here, and then we can see in one candle there was that spike out of the box. That is obviously a stop hunt to the high. We know that is a stop hunt to the high upon seeing this confirmation candle, this candlestick pattern right here. We know there's liquidity trapped in this zone, and the dealer cannot go above this area without releasing liquidity that he has trapped. So, what does the dealer do? The dealer spikes up once more, but not past the high that he has originally created. So the spike up and then that reversal. And not every day will be filled, right? Some days the dealer has to consolidate, and some days the dealer will move much more or a bit more than the average daily range. Here we can see the high and the low correlate almost basically exactly with the 74 pip range. Here we go again. And how could we trade this? So let's say we see yesterday's high. Let's say we're right here. We're trading right here. This is real time. We see yesterday's high is right here. We see that small spike to the high. Oops, there we go. This spike to the high. We could sell here and then take profit at the daily range. Or if we didn't catch this, we could just use our box, put it at the high of the day, see all these spikes happening at the low that has been created right here, and the low correlates with the daily range box. Alright, I'm taking this long, right? It shoots up. The daily range has been filled. So what will the dealer do? The dealer will either, upon filling the daily range, the dealer will either reverse or consolidate and end the day. So, here it is again. Let's say we're here, we're at this day, and we have drawn out this consolidation here. We can see the low of the day, the previous day, has trapped orders in this area, in this range, right? In this zone. So, upon seeing this stop hunt to the low, that railroad track to the low, we buy. We now see the daily range has been filled. We could sell at one of these wicks, or sell here, or sell here, or sell here. The daily range was filled, so now the dealer must retrace. The dealer did not retrace that day, but he ended the day in consolidation to gather more orders and then retrace. still worked the high of that day. You can see right here. And the previous day was also worked. So, using this box, we can see visually the daily range. And upon seeing the daily range has been exceeded, we can expect some sort of retracement. We can see the 73 pip, 74 pip range has been exceeded. One candle. There's a trap here, a trap here, trap here, another trap. All these are sell opportunities to take it against the trend a bit. Again, we can see the low and the high. The high was exceeding the average daily range, but it was not broken. The average daily range was not broken on the 15-minute chart. We can see these are all trap moves. Trapping retail traders at the high of that day to then drag price against them. Here it is again. Now remember, this is only a average, you guys. In the next few lessons, we will be going over how to see the market without using any indicators or averages whatsoever. Because we know that the market is a 100% unique environment. And when we realize this, we know that we can't use technical analysis because technical analysis is based on the past. It's based on past events, and we try to determine the future based on these past events. So, just realize that, you guys, and take this lightly, use it as a tool, but remember, it is only a tool. Here we can see the low was created here. After that, that consolidation period, and then that spike to the low, we can see that is the stop hunt to the low, that large candle, and then comes up off the low, spikes to the high, also fills the ADR upon spiking to the high, and then comes off of the high and then consolidates. We can see after this consolidation, more consolidation occurs, and then there's that spike to the high once more to create that M formation that you can see right here. We could sell right here, or also in this area. Alright, let's go over our next topic, liquidity. like we've talked about, there's liquidity trapped in these zones, the highs and the lows. So the dealer, upon trapping a certain amount, isn't going to release or isn't going to give the traders time to be released after being trapped. In other words, we know there is a trapped amount of liquidity in this area. Upon spiking up here, the dealer trapped breakout traders in this area. 5 days later, the dealer spiked up into that area again, but very, very fast. And any breakout traders that were looking to get out at break even didn't really even have a chance, because this spike up happened so fast. And the same with the low of the week. The low of the week, the dealer came down, created that low, and then trapped as many people as he could, and then worked off the low and reversed. We can see another trap right here. This was the high of the month. This was a big news event that filled the average daily range. It came up, spiked into the high, or into this liquidity zone, very fast, keeping as many people trapped up here, yet hitting as many stop losses as possible. So, stop loss and take profit zones. We'll talk about those next. Oops. Okay. The dealer, or I should say, retail traders, me and you, were taught to place our stop losses above the high, above the highs and the lows of the day or the week. And it's very strange when the dealer gives people or us this much time to sell if the price is really going in the sell direction or to the downside. So it would be strange that the dealer would let people ride this trend all the way down without hitting stop losses. And that's what the news events are for. A lot of times, you can see here, a news event spiked the market up, filling the average daily range, but spiking past the average daily range into this zone where our stop losses would be if we were selling in this area. Retail traders that were selling in this area got stopped out, and then the market went in its intended direction. So, the same happens for take profit zones. The dealer knows that he has sellers that have seen this and have sold, and there are people in profit with their take profit levels above the, or I should say below, the low of the month or the week. And where is this? Well, we could assume that there are take profit levels in this area, because this is the lowest point that happened when we were here. So if a retail trader sold here and is targeting this lower low, because he thinks the trend is changing and will create a lower low, the dealer does not give him the opportunity to have his take profit hit. He will work that area but will not spike into that range because he knows there's too many take profit zones in there for him to make a profit. So the next topic, I believe, were liquidity zones or trap zones. Trap zones happen all the time. There's trap zones everywhere, and a lot of people get these mixed up for support and resistance. You could say that right here there's a good support and resistance area, or right here, or right here. What's really there is money. There's money in these zones. There's liquidity in this area, and that's why the dealer spikes into these zones and traps a certain amount of liquidity in these zones before moving on, before moving to the next zone. The dealer will often consolidate in one of these zones or spike into one of these zones to hit stop losses or search for liquidity that is needed to balance out the market. And you can determine this by seeing these large stop hunts in these zones. You can see it really sticks out when you have these zones drawn out. Now, you don't need to draw these zones out. All you need to do is see them with your eyes, but this is just to visually help you see what is going on. So these would be considered trap zones or liquidity zones, liquidity areas. Now, let's talk about the high and the low a little bit more. Let's discuss it a little bit more in depth, because I feel like we need to discuss that just a bit more. So after these consolidation periods, which, you guys, about 5 to 6 hours before the market closes, this was 5 hours, and 5 to 6 to 10 hours after the market opens is when the market will be in consolidation, or I should say after this session changeover. So you're not going to want to trade unless you know what you're doing. You're not going to want to get stuck in this consolidation area. You're not going to want to look for highs and lows in this area unless you really know what you're targeting, unless you really know what you're doing. So this eliminates a lot of the stress, a lot of the work, because now we have a time zone in which we know this reversal or this whipsaw movement will happen. We know the high and the low will be created in this area that we have to work with. So we can see after consolidation, this consolidation period lasted about 12 or 13 hours and then broke out to the low, created a low. Okay, when did this happen? Well, this was Asian session. After Asian session comes London session. London session, it looks like there was a low that was created, a hit to an area, a certain zone that was not broken but tapped for liquidity. Upon seeing all this trapping going on, all this trap movement going on, this structure right here, you could take this long. Because you could reckon that that is the low of the day and take it up to the next zone, to the high of the day. And it's better when it's correlated with the ADR, the average daily range. It's the best when those are correlated, but you'll be able to see this no matter what after you get your eyes adapted to the marketplace. You can see this obvious large consolidation here. There was a spike to the high, this news event, some type of news event, spike to the high. After the close of this candlestick, we know what to do. We already know what to do. We sell there. No questions asked. We're already in London session. We see that spike to the high to hit the stop losses of any sellers, and then that's when we sell. And look at that, instant drop. That small W formation, and then comes up, finishes the day in consolidation. So this is what I want you guys to see. Asian session is the Asian session and the end of New York session consists of basically consolidation. The opening of London session, or in the middle of London session, or right before the opening of London session, will have some sort of manipulation move to create that high or create the low, and then finish off that whipsaw movement, that daily pattern. This all happens, this small move all happens, or I should say this large move all happens in a 5-hour period. Or if we wanted, we could say it happened in a 1-hour period. This was 1, 2, 3, 4, 5 bars. 1 hour, 1 hour 15 minutes. The entire daily range was filled in 1 hour. The whole other 24 hours of the day, or I should say 23 hours of the day, consisted of consolidation. So you have to understand when these moves are being made, when to buy and sell, when the high and the low is created. This is why consolidation is so important, you guys. Consolidation is one of the most important structures. And this is our last topic, completing the structure. Consolidation, without consolidation, there would be no market. There would be no liquidity, and there would be no market. So, thank you guys for joining us. This was really basically the high and the low lesson. There isn't much else to talk about. Everything else is basically adapting yourself to seeing the highs and the lows being created in front of you and adapting to real-time scenarios. And this all comes with hard work and adapting yourself to seeing these different variations and structures. So, thank you guys for watching. Until the next episode, peace out.